In this October RBA and economic update, which we share to our Empower Wealth and Property Couch communities, my theme mainly is going to be about an improving economic story and also the other big news around an improving housing story. So let's get straight into it. The RBA governor and their board met today and they kept the cash rate on hold at 0.25 of 1%. Now, there has been a lot of talk about a potential move when it comes to that cash rate. So we'll talk about that in a moment. Let's turn our attentions to a strange occurrence, right? Today, it's unusual that I'm talking about a federal budget, which is going to be delivered tonight. Obviously, we normally have the budget delivered in the first half of the year, but obviously in these unprecedented times, we're seeing the budget being delivered on the 6th of October. So that's one of the big things. Now, the big takeaway, which will be confirmed tonight by the Treasurer, Josh Frydenberg, is most likely we will see tax cuts, personal tax cuts, which will be backdated to the 1st of July of this year. So we're going to see personal tax cuts coming through. We might even see some tax cuts for small to medium-sized enterprises. We are forecasting that there will be infrastructure spending, and they will be the big pieces of the economic story tonight, because it is all about jobs, jobs, jobs. So you'll hear that coming through from the federal government over the coming weeks and months as they try and get the economy back on track because of this obviously pandemic and health crisis. So lots to get through this month. We'll start with that in terms, firstly, the health crisis. So we did see through the opening of a lot of economies and movement and mobility of people in a lot of countries that we are starting to see some increased cases of the virus and the infection rates increasing in areas like Germany, Israel, Italy, Poland, Malaysia, Moscow, and obviously we're hearing that coming out of the UK as well. We're definitely hearing about flare-ups in areas like London, New York, and overall Brazil and India are also obviously got some very, very large challenges around their population sizes and controlling this very, very dangerous virus and highly contagious virus. On the other side of the virus is the vaccine story. So we have obviously several drugs in stage 2 and stage 3 trials, and it was reported by Pfizer at the end of last week that they will be reporting at the end of October on their efficacy of their vaccine, and also most importantly whether they did see it working. So they are going to see some reports coming out. So we'll see more of this coming out in terms of all of these different vaccines that are under trial in terms of how they're progressing. So that is exciting news as we come to the close of 2020 and in terms of what's going to happen there. And what's also more importantly about that is what is the rollout going to be as we wait and see whether these drugs are going to work and we will have a viable vaccine or multiple vaccines to quell the coronavirus as we know it. In terms of the world economy, again, on a little bit of a positive news front, the OECD have adjusted their global economic forecast. They did expect that the global economy would shrink as much as 6%. They've now revised that down to only a 4.5% contraction this year. And their revisions have come through changes in their US and the Euro area in terms of a better forecast for those particular markets, as well as China, which is now forecasting moderate growth in those markets. So by way of example, the US is expected to contract by 3.8% versus a 7.3% that they early forecast. Now, like any of these sort of things, there will be spikes in cases, and that could affect obviously how bumpy our recovery is going to be, but it's certainly going to be bumpy until such time as we have a vaccine in place and we can get on top of the health crisis that we've got. Turning our attentions to the US, obviously the biggest news coming out of the US probably this year is Donald Trump contracting and testing positive to the coronavirus. We obviously are seeing reports coming out that he is on the recovery pathway. So that is obviously positive news for him, and also for the plans for the election, and also what's going to happen for the economy as well. So that is hopefully a positive news story on the back of him testing positive to the coronavirus. In terms of what we're seeing around interest rates, we saw Jerome Powell coming out this month really talking about keeping the current interest rates unchanged at near zero levels, and also a really clear indication and signalling to the market that we're going to be keeping those rates there for at least 3 years as they focus on a very strong recovering economy. So they are not going to move that cash rate anytime soon until they see a very, very firing economy on all cylinders. So that is something to take note of. And that obviously is all about signaling to business to keep that economy moving and getting those jobs up and running. And so there will be no changes there. And even if inflation does lift higher, that may not necessarily be a trigger for them to move the cash rate anytime soon. On the jobs front, the number of Americans who applied for jobless benefits fell slightly to 837,000 for the week ending September 26. This is the lowest level since the start of the pandemic. Now, interestingly, the data was compromised because California, which is obviously a very, very large economic state in the US, but globally is also a significant economy when you put in all of those tech stocks into that particular state. They are not accepting any new applications until early October, until this month, right? Because what they've had is large processing backlogs, and also they're investigating reports of widespread fraud. So the numbers aren't necessarily super reliable when it comes to those jobless benefits figures. When we talk about the property market over in the US, it's quite fascinating. The numbers are strong in every area that we look at it. In terms of pending home sales index surged 8.8% in August to a record high of 132.8 after a strong gain of 5.9% in July. Now, on a year ago, pending home sales rose 20.5%. Now, that is challenging considering, or interesting considering, that the unemployment is elevated. Low interest rates are certainly spurring on demand for housing, especially in low density areas as people try and spread out a little bit more. Constructing spending jumped 1.4% in August following an upward revised gain of 0.7 in July. The top 20 cities house price index published by CoreLogic in the US showed a gain of 0.55 in July, which beat market consensus expectations, as was an improvement on the flat outcome in June. This index is now at record highs. The annual rate lifted to 3.95 in the month. Then we turn our attention to new homes, continue to surge gauge. So they had record numbers in terms of surging gains to breach the $1 million mark of home sales. Now that is a level that has not been seen since late 2006. So that's positive. Then we turn our attention to sales of existing homes rose by 2.4% to an annualized rate of 6 million units. Sales were 10.5% higher compared to a year ago, which is the fastest annual pace since December of 2006. So there is a lot going in regards to the US housing market. Finally, the housing market index rose to 83 in September from 78 in August, according to the NAHB report. The index is widely watched as a sentiment gauge for the outlook of US housing sector. So these September results are the highest since the data series began back in 1985. So fascinating to watch what's happening in the US housing market. Overall, the economy, the Federal Reserve's Beige Book reported that US economy expanded in August, but many parts of the economy experienced slower growth amid lingering anxieties over the pandemic. The Beige Book also reported that continued uncertainty and volatility related to the pandemic and its negative impact and effects on consumer and business activity was echoes themed around the whole economy. Let's talk about the budget deficit. Is going to more than triple to a record $3.3 trillion this fiscal year. And national debt will exceed 100% of the economy next year for the first time since World War II. and this is a frightening number, but US government debt will increase to $33.5 trillion by the end of 2030, or 109% of GDP. Ouch. They need to do something about spending. In terms of China, their economy continues to recover on the job front. The jobless rate in China fell to 5.6% in August compared to 5.7% in July. Unemployment peaked at 6.2% in February, having been at 5.1% in November of last year. So their economy continues to improve and the unemployment rate continues to fall. In terms of the property story, the annual pace of growth in the property investment picked up from a 3.5 in July to a 4.6 in August. Meanwhile, fixed asset investments remain soft year-on-year pace of negative 0.3. The overall improvement on a negative 1.6 pace in July. House prices rose at their fastest pace in August, adding to signs of a gradual recovery in Chinese property market. Home prices rose by 0.56 in August, following a rise of 0.47 in July. Annual growth eased slightly to 4.72 in August. The overall economy, well, we're just seeing all of the indexes point to the official Purchasing Managers Index of the compromise, which is the Manufacturing and Service Index, showed improvement in September. The PMI rose 0.6 of 1% to a 55.1. The manufacturing index rose half a point to 51.5, and the services PMI rose 0.7 points to 55.9. All three indicators are above the 50%, suggesting an expansion in activity in the months ahead in these sectors. It also underlies the strong economic recovery that is underway in China. So good news story there for our the Chinese economy. In terms of the Eurozone, the other big economic sector, the unemployment rate in the Eurozone lifted from a revised 8.0 in August to 8.1 in September. This is the fifth consecutive monthly rise. Further rises are likely as wage support programs expire, and an increase in infections in many countries raises fears of some restrictions on business interactions that may be imposed. So that's just something to follow there. The GDP numbers, well, GDP in Europe fell to 21.1% for the June quarter, to be down 15% overall for the year. Unemployment slipped 2.8 for the quarter, having fallen 0.2 in the March quarter. So lots of challenges there in the Eurozone as they also manage the virus. Let's turn to Australia now. And again, it is all about an improving economic outlook and sentiment as part of that story. The big news probably for the month from the RBA came from mid-September. The Reserve Governor's Deputy Governor, Guy Debelle, delivered a speech titled "The Australian Economy and Monetary Policy." He outlined that the economic recovery was a slow grind and that we do face a gradual and uneven recovery. That is true. He also noted that the RBA was very open and prepared to do more stimulus if required. Now, during his speech, he talked about what those options were. The main preferred options appear to involve a further cash rate cut, so moving the cash rate down from 0.25 down to 0.1 of 1%, and also cutting the targeted 3-year government bond yield by 15 basis points to bring that also down around to 0.1 of 1%, which is a further attempt to support lending, because that is obviously what is going to stimulate business investment and get the economy moving. Now, given that there was no change in the cash rate this month on the back of the federal budget being delivered tonight, the attention is definitely turning to the speech by Governor Lowe this month in terms of what the economists will do as a read on further action from the RBA, and whether that will come as soon as the November board meeting. In regards to GDP, no surprises there in the results that came through, that the Australian economy contracted by 7% over the June quarter, which took us into recession. It was obviously the largest recorded on history, results and records back to 1959. And yes, again, we are in recession. That has been confirmed. Now, given the lift of COVID cases in New South Wales and Victoria over the September quarter, so we are starting to see Victoria get on top of its second wave down here, that we are starting to see potentially the September quarter could be challenged with a negative number. So we're now probably turning our attentions to a December quarter positive number to end that recessionary period. The recovery pathway continues to remain uncertain and uneven, but given the way in which New South Wales, Queensland and other states and territories have been able to manage it, and the fact that Victoria are on top of this current outbreak gives us some confidence in regards to that. And then we look at the 6-month annualised growth rate in the Westpac Melbourne Institute Leading Index, which indicates that the likely pace of economic activity relative to trend 3 and 9 months into the future rose from a negative 4.42 in July to a negative 2.56 in August, which continues to point to an improved recovery in the economy. And I suspect we really do want to look at those numbers coming through now for September and October once the Victorian economy moves out of its restrictions. So again, the other big theme other than the improving economy is jobs, jobs, jobs. So let's look at the unemployment rate. It was quite surprising that there was a bumper employment story for August, where we did see unemployment surge, or employment, I should say, surge by 110,000 in August, the third largest monthly increase on record, trailing only increases seen in June and July. And the outcome far exceeded most expectations from economists. So that was a really, really surprising story, given that obviously Victoria was in lockdown during those results. The unemployment rate declined as more Australians found work. So there was a 0.7% decline, and the unemployment rate now currently sits at 6.8%. Nonetheless, employment still remains 421,000 or 3.2% below its February level. So more needs to be done there. And again, in terms of what that also means, we wanted to focus in on hours worked. It only rose by 0.1% across Australia for the month of August, and remains 4.6% below the hours worked that we saw in February when the economy was at its peak. The participation rate also edged higher as more people who came off benefits now need to start looking for work. So it moved from 64.8 to 64.8 from a 64.7 in July. Now the participation rate back in February was at 65.9. So still some work to do when it comes to that. Unemployment rate, the underemployment rate remains steady at 11.2% in August, but is down from its peak of 13.8 in April. And again, remembering in February, the underemployment rate stood at 8.8%. So lots to do there. On the job ads front, so job vacancies rebounded by a record 46.7% in the 3 months to August, following a drop of 49.3% in the previous 3 months. The construction industry led the recovery at the fastest level, with job vacancies expanding by nearly 92% in that month. So obviously the stimulus that's coming through in the construction sector by the government is doing very well. ANZ job ads rose 1.6% in August, following a 19.1% rise in July. So we will turn our attentions to the job ads data that's coming through this month as well. So it's really important to understand where we sit. In terms of in August 2020, there were 109,000.1 jobs added compared to 155,000 jobs added in August of 2019. So definitely off our lows, which were April, where we only saw 63.5 thousand job ads advertised at that time. So starting to improve. The Aussie dollar, we did see it have a fairly good run through August, but in September, we saw it drifted downwards against the US as more cases of the COVID virus spread out. There was definitely a safe haven flowing to the US dollar, which put pressure on the Australian dollar against the US. And so that's why we've seen the Australian dollar come down towards that 70 cents mark. In terms of what we're actually seeing is that most economists and banks are forecasting that the Australian dollar will move higher against the greenback in the coming weeks as the world digests the economic activity and the impact of the election that's coming up and who will win that election as well. So now our long-term Australian dollar versus the US dollar is around 76 cents. We potentially see more of that happening unless we see that intervention by the Reserve Governor and the board there in terms of bringing that dollar back down through monetary policy stimulus. In terms of consumer confidence, and this is coming back to an improving economy story, the weekly Roy Morgan survey of consumer confidence showed another improvement in the latest week's data ending September 27. The index lifted 1.5% to 95. It's the fourth consecutive week of improvements. Remembering that 100% is balance. Anything above 100 as a score is an optimistic as opposed to pessimistic view of the economic situation. So there's more pessimists than optimists out there, but that also is improving. The other big indicator here is the Westpac Melbourne Institute Consumer Sentiment Index, also rebounded in September, given that the cases of the COVID virus were falling in Victoria and New South Wales. The index lifted from 79.5 in August to 93.9 in September. And it's the highest since the COVID-19 was declared a pandemic by the World Health Organization back in March. Looking at sentiment across all states rebounded and was led by a 22.3% gain in New South Wales, and also in Victoria lifted 14.9%. Now their reading is currently sitting at 89.6, which is the lowest of all states. And to put that into context, of the highest of all states is Western Australia, where their index lifted 18.6% to an optimistic reading of 101.9. So that's where we all want to head to get back into that positive territory. Now looking at retail spending. Now retail is an important aspect of our economy. It employs 1 in 10 people. It represents 10%, that's right, 10% of the Aussie workforce. So it's important that we get strong rebound in retail spending. We have had obviously a very, very strong retail spending story since May, but we did see the August numbers taper off and took a backward step as retail spending fell 4.2% in August. But again, that was probably when we were a little bit less optimistic. So we did see people's closing their wallets and purses as we were trying to grapple with closing borders and movement of viruses between New South Wales and Victoria. So that was a disappointing number. Let's see what happens as we look towards the September and October numbers as we get more mobility and we open up our economy a little bit more, especially down here in Victoria. In terms of business confidence and conditions, after 3 consecutive months of improvements, the business conditions did deteriorate in August. So again, we're looking at this lag data to a negative 0.6. So those resurgent in cases again in Victoria did dampen the enthusiasm of business confidence. That said, there was some encouraging news in the confidence improvement from a negative 14 in July to a negative 8 in August. Although confidence remains well below the long-term average, it does suggest that businesses remain cautious about the outlook to keen to get the road to recovery and keen to get a read on those September and October numbers as we come out of those restrictions. On the manufacturing front, the AIG Performance and Manufacturing Index fell in September to 46.3% from 49.3 in August. This is the lowest reading since May and is below 50, suggesting there is still some contraction that is happening in the manufacturing sector for the periods ahead. But we have seen prior to the budget, and we'll get more information in regards to that, but the federal government announced a $1.5 billion package to assist manufacturing sector as they turn their attention to producing more materials in Australia as opposed to importing materials, and obviously that will result in more jobs for the Australian people. So that said, that we've got some challenges when it comes to the business side. The consumer side is also hopefully getting a little bit more confidence around that sentiment piece. But when we turn our attention to the property market, it is definitely a different story. So is it one of that the property sector is going to lead us out of this economic slowdown and into a recovery? Well, let's have a look at some of the stories that are going on here. In terms of housing finance, we did see new lending rise across, in July, and the market continued to recover from the worst of the COVID-19 downturns. Total new lending, excluding refinances, rose by 8.9, following a revised 6.4% increase in June. Owner-occupied lending led the charge in July, rising 10.7% off the back of a 5.8% increase in June. Investor lending was positive, with a 3.5% increase in July after an 8.3% lift seen in June. Now, prior to that increase, we did see investor lending was falling for the previous 5 months. So that says to us, and again, we're still looking at lag data. I suspect those numbers will be better for August, but because Victoria's property market was effectively shut down in September, we might see some ordinary numbers coming through there. But again, that's not because of the lack of demand or interest in this particular sector. Construction, there was a slight pullback in building approvals in August following a surge in July. Approvals were down 1.6% following a 12.2% rise in July. Over the year to August, approvals are up 0.6%. The trend in the data is now evident that their housing approvals have definitely led the charge. They rose 4.8% on the back of an 8.6% lift in July, but apartment approvals continue to slump and be in negative territory. On a state-by-state basis, we did see massive variations too. So in terms of Tassie, negative 26.2, New South Wales, negative 14.2, were sharp declines. Approvals also fell in South Australia, 4.9. On the other end of the scale, Western Australia reported 33.8% increase in approvals, as did Queensland, was also up 8.1%. And surprise for Victoria, also rose 1.8%, even though it's in lockdown. So let's turn our attention to property prices and what's been happening in the property market. It's very clear that the bearish outlook that was anticipated in terms of major corrections in the property market have not materialised. We did see CoreLogic's results come through for September, showing that dwelling prices fell only by 0.2 across the 8 capital cities in September, but importantly, rose in every capital city except for Melbourne and Sydney. Now, the reason for the negative price falls across the market is that New South Wales and Victoria represents 40% of the overall property stock, and it also represents 55% of its value. So that's why you put it into context. So let's go through those numbers. We did see Sydney for the month negative 0.3, which for the quarter is negative 1.6. The annualized gain still sits at 7.7. Melbourne, negative 0.9 for the month, negative 3.3% for the quarter, but still sits positive at 3.1% annualized. Brisbane had positive of 0.5 of 1%. For the quarter was flat, annualized 3.8% growth. Adelaide had growth of 0.8 of 1%. For the quarter, 0.9, an annualized 3.6% growth rate. Perth, 0.2% growth for the month, negative 0.3 of 1% for the quarter, and negative 1% for the annualized year, but improving. Hobart, 0.4 growth for the month, 0.3 growth for the quarter, and 6.4% annualized. Darwin, the strongest for the month, with a 1.6% increase in property prices. For the quarter, 2.3%, and annualized 1.9%. Canberra, 0.4 growth for the month, 1.5 for the quarter, and growth overall of 6.3%. So combined capital cities, as I mentioned earlier, down negative 0.2. In terms of the quarter, down -1.5, annualized up 4.9%. Combined regions, and the regions appear to be growing quicker on the month at a 0.4% increase, up 0.5 for the quarter and 4.3% for the annualized year. So that meant that nationally, we only saw a negative 0.1 fall for the month. For the quarter, negative 1.1, and annualized still sitting at 4.8% growth. So that just goes to show you what's happening out there. Now, obviously, the market has been insulated on a couple of areas. One is that most of the buyers and most of the sellers have decided to sit on the fence and not do anything over this period and watch to see what happens to the marketplace. So it's pretty clear to me that those people, those buyers who have taken action or are going to be taking action in the short to medium term are probably going to see a lot more upside in terms of the return they're going to get. So if you're a buyer and considering to looking at the market, it's now time to start doing that research if you haven't already bought yet, as we see the marketplaces starting to open up a bit more as we get on top of the virus spread. In terms of, as I mentioned before, the regional dwelling prices have been quite strong, and that's also potentially a product of behaviour around potentially looking at getting out of the larger cities or relocating to better opportunities, as both obviously Melbourne and Sydney have the greatest risk of the spread because of its populace. So that's interesting. Now, I want to talk a bit about the property outlook. It's not very often you see that the stars continue to align like they have. And so I want to just highlight, not take a deep dive in here now. We'll probably take a deeper dive into this content in the upcoming podcast this week when we review the budget in more detail after it's announced. But also, you know, what are the indicators that are pointing towards a more positive outlook for the property market? So I just want to summarize these very quickly. Certainly, we are seeing a recovering economy. Yes, it is patchy, it is uncertain and unclear, but the path is clearer and clearer. We're certainly treating the virus better. We're getting better health outcomes, and obviously we will see a vaccine at some point. So that improving economy, greater mobility for people to move around, border openings to see people move, opening up of restaurants and bars and travel is going to also see us spending more money in the economy. There's definitely a consumer sentiment recovery as we continue to get on top of those outbreaks. That is positive for us. There is a recovery in the jobs market, which we're definitely seeing showing up in that unemployment rate. More to be done there and more stimulus to be added. When we turn our attentions to property stimulus, we obviously saw the government announce on the weekend as part of this budget announcement tonight that there will be a further 10,000 home deposit places available for people with some changes to that. So only a 5% deposit needed, and it's going to focus on new construction. So that is also going to put some further stimulus in the construction centre, in the residential marketplace. Then we also are starting to see a reduction in the risk in regards to mortgage defaults. And I want to spend a moment in talking about this because the systemic risk has faded. So we did see, reported from APRA that across all of the ADIs, loans that are subject to mortgage deferrals totaled 229 billion, or 8.5% of all loans, according to that APRA data. Now, the housing loans subject to repayment deferrals accounted for 160 billion of that 229 billion, or 9% of all housing loans. Now, that's down off its peak. Now, this is where it gets quite interesting. Exits from the deferrals continue to outweigh new entries for the second straight month. So what we're saying there is there was 24 billion loans expired or exited deferrals, which means that they are now back on track and they are not pushing the can down the road. And there were $14 billion worth of entries were approved or extended. And so that would most likely be, people in the Melbourne property market where they have been impacted by their job security. So there they have pushed the can down the road. But most importantly, the pace of exits has slowed over August, with total exits of 24 billion in August compared to 40 billion in July. Now that's a drop of 41%. So that's basically still saying that the exits are slowing, but we're now starting to see the people who are at greatest risk and how we now look after those. But if those numbers continue to slide down overall, we're not going to see that systemic risk posing a problem for house prices across the whole market. I've said it before, the risk is in medium and high density, because I feel that there will be some exposures in those markets, including poor performing values and also risks around high vacancy rates in those particular areas, which is putting more pressure on households being able to service those loans. But the majority of the loans have now returned to a performing status. So that's pleasing to see coming through there. Now, so what we're seeing and how I summarise that is we aren't necessarily seeing, again, that systemic risk coming from that loan deferral program that we saw. On the back of that, closing out this area, record low interest rates could potentially be going even lower, and that could see some of that money passed on to lower interest rates for consumers. Let's hope so. So we know record low interest rates also stimulate price and buyer activity. So that could also bode well for improving property prices, which has a flow-on wealth effect. And the other important announcement that we saw last month was the government's proposal to remove the laws around responsible lending. So this is on the back of plans to introduce a best interest duty for mortgage brokers and people facilitating lending and mortgage lending. And I think this is a good decision in terms of getting the balance right. So it now is still going to continue to put the onus on the borrower to make sure that they are able to borrow that money, as opposed to the onus was on the lender, which naturally resulted in lenders being very fastidious about how they assess lending, and that was resulting in less lending taking place. So we've got to make sure that that balance is right. So APRA will now be in control of how prudent lenders will be, and ASIC will no longer, if the legislation gets passed, be responsible for administering responsible lending laws. Now, the other good news in this legislation was, and I think it's a smart idea, that we kept the higher risk non-bank products, which was basically payday loans, small amount credit contracts, and consumer leases. They will remain in place, and ASIC will still be the watchdog that looks over those products and potentially can be the cop on the beat, strengthening those risks. And that ensures that those vulnerable borrowers are protected, because that is where those sharks play. So we don't necessarily want to see that type of market continuing to see poor outcomes for households and borrowers. But more broadly speaking, with the introduction of best interest duties to making sure we're doing appropriate lending from a lending point of view for mortgage brokers, and also the removal of the responsible lending components, should see improved activity and lending activity, which will also help the property market. Obviously, once we get a vaccine, we will potentially see the arrival of more foreign students, which will put demand on the rental accommodation, and also migrants starting to arrive as we organise that program of new arrivals into Australia as part of that. And then finally, obviously, the reports coming out today that these income tax cuts will be announced tonight, that will be retrospective from 1 July. That obviously puts more money in people's pockets. That also potentially improves borrowing capacity, and that will also see some further demand stimulus coming into the economy and into the property sector. So with all that said, if you weigh up the pros and cons of the property market, we're potentially seeing some brighter horizons than what we may have seen potentially when we were quite panicked around the pandemic. back in March and April of this year. So it'll be interesting to see how that plays out. But we've been consistent in our messaging around we thinking that the property prices and the broader market will be back to positive territory. We still believe that medium and high density properties will be challenged for the short term until those foreign students and migrants start to come in reasonable numbers, and that will also stimulate further activity in terms of construction for medium and high density. But the broader property market, the traditional property market, the existing property market, and some of that new construction in house and land packages and lower interest rates will probably see the rising tide again lifting all ships and the property prices continuing to go higher. So again, if you haven't already reached out to us, again, talking to the Empower Wealth community, please do so. If there's an opportunity there for you, we'd love to have a chat with you about looking at your borrowing power and your lending situation. That's also available to you. And our buyers agents, now that all markets are open again, have been actively buying in Queensland, New South Wales, Victoria and South Australia. We'll continue on that journey. So if we can help you in that space, please reach out to us. You know where to find us. And also for our Property Couch community, remember, knowledge is empowering, but only if you act on it. So now's the time to start doing your research and to start lining up your ducks to make sure that you can execute, because we're going to see potential strong competition in certain segments of the market, and you want to be ready and organised and understand where market value is at in particular sub-markets, so you can hopefully enter the property market as well. Until next month, hopefully you'll get some value out of this information, and I look forward to giving you an update on what's next in regards to the cash rate and the economy as we see the budget effects start to flow through. And we're also going to see some announcement in the state government's budgets, which the rumour mill is suggesting that there may be some changes also in the property sector, which could be very positive to increasing demand. So stay tuned for that update in the coming month. Until then, take care, and remember, knowledge is empowering, but only if you act on it.